moved. And when we have Mike Muller, we actually get big in our sense of time and do month in review because we have a great opportunity to hear from Mike. So let's kick off there. Mike Muller, head of Vitol in Asia. I'm going to start, Mike, with that very confusing survey question that was just popped up. IDA has disrupted or has shut in more oil than OPEC has cut in the last, August and now September. And what will the continuation of that trend do? I mean, we've propped up oil prices to $73 on a close on Friday. Where does it go from here? What's your outlook? And welcome, Mike.
Thanks very much, Sean. Great. Yes, Hurricane Ida clearly was a big fundamental influence on markets, and has probably, even though the state of Louisiana was a lot better prepared than it was when Katrina struck, it was nonetheless reminiscent in many ways of the outages on the upstream, and the numbers for these outages have kept creeping up. And we mustn't forget, of course, it's not just offshore production that gets shut in, and the high-profile issues around the infrastructure, around the Mars network, for example, but also refining infrastructure gets shut in. So it hits both sides of the supply and demand equation, and it means a bunch of things. But the fact that the initial estimates of how much production would be out, which maybe have been in the 20 to 30 million barrel total number, that's edged up much closer to mid-40s now, million barrels. And that's the refining capacity that's out. And of course, we don't really know because we still had refineries which had issues with water and with power. But some signs in other those are coming back, and therefore the consensus seems to be we're talking mid-40s millions barrels lost in terms of refinery product output, and then balancing that on the upstream side, not just the Mars network of production, but other fields also, currently totaling a figure that's somewhere just below the 40 million barrels. So all in all, that has meant a few things. It's certainly underpinned refining margins and cracks because other refineries have had to be incentivized to run harder to make up perceived shortfalls. And it's meant a total rearrangement in supply because the US Gulf tends to be a big exporter of diesel to Latin America, which needs a little bit more fuel right now because they've got drought issues. And that's totally realigned trade flows around the Atlantic, creating a much, much tighter products market and much stronger refining margins. But the story's not over because we're seeing from some of the stories that you've just put up here that the upstream production is still down. And the consensus now seems to be shifting towards there being a more lasting impact in oil outages. But again, we have to, as in offshore production outages, but we have to cast our minds back to what happened with previous hurricanes. I don't see any reason why the offshore infrastructure should be out for any longer than was the case after various other facilities. There was a scare around the WD-143 facility that shall operate that ties together roughly half of the total Mars offshore production. But that's okay, it seems, and they've started repopulating their offshore platforms with bodies. But as of yesterday, if we believe what we see, 1.1 million barrels a day of soap production is still down. But surely we'll have closure on those numbers soon. But that's a big hole that was made in global supply, and of course, therefore, it's seen as bullish.
Let's welcome Christof Rühl, Senior Research Scholar at the Center on Global Energy Policy, Columbia University. Christof, even despite that major outage, oil prices have climbed, but they've just climbed ever so incrementally. I mean, if Saudi Arabia had come out, as we've speculated on occasion, and cut 1 million barrels as they did in January, you'd expect prices to spike through the roof, 1 million barrels a day. On this occasion, they're moderately reacting. Your thoughts?
You're right, and you can even push it a little further. You could point to another statistics which also came out this month in the US, according to which the claims of unemployment for new unemployment are now below the offers for new jobs, and so that indicates a red hot economy on top of these IDA outages. And what both of them refer to is, it's true, the IDA outages are 1.4 million barrels per day at the moment upstream. What both of them indicate is that there's just a plentiful oil supply all over. You can add to that, even if you do the numbers which came recently out for August production of OPEC Plus, you see that they're still way above or below their quota, so they're actually producing less than they've announced. And in particular, the increases in the plus segment of OPEC, so from all the countries other than Russia, have been very moderate, or they have been actually declined. So they can't even produce up to their quota. That would be another bullish indicator, and still oil prices are only up to 73. So even if there is a short-term spike right now because of this accumulation of things. It just indicates how well supplied markets are. It indicates the knowledge that shale is coming back gradually. It indicates the expectation there will be more production in the North Sea, in Brazil, in Guinea. And there is just no reason for markets to get super excited about it. And you combine that with the economy side, the demand side of the equation, you see economic growth not really exactly taking off like a rocket. You see more worries about the Delta virus and possibly other contagions. And so it explains a much more moderated picture, both in terms of the economy drive as the major factor of demand, and in terms of the available oil, despite driving down of inventories, Hurricane Ida, inability of OPEC Plus to actually implement the cuts, and weak economic demand, and stellar economic demand for a flashpoint in the US, all combining, not lifting prices much higher. I think it confirms those of us who said on fundamental grounds, plenty of oil in the world, full stop.
Mike, on that point, looking to China, and I'd welcome your own thoughts on the question too, Christof. China, of course, has indicated a recovery in the last few weeks, or the last few data points that have come out of there. Your thoughts on where China goes to keep this oil market well supported?
I've always said that China is growing and will keep consuming more oil. That's a given, right? But of course, we're seeing many headlines of late, most of them surrounding the Strategic Petroleum Reserve or the Commercial Petroleum Reserve, where there undoubtedly has been some policy directive that these stocks can be drawn down by one or more, but one particular of the state-owned enterprises. But the Strategic Petroleum Reserve, in terms of days cover in China, needs to go up as demand goes up, and therefore the mindset there is always very clear. They make it very clear that this is a fill and then replenish type policy. And a lot of people have been speculating that, yes, at 70 something or $80, they will release. And at closer to 70 or $65, they're less interested in releasing. That's pure speculation. But there is also an undertone, I guess, of a desire to just be commercial with these inventories because they cost money to have in place in the first place. And of course, it's a read across from other commodities where China has much more severe issues than they have with oil right now. If you look at what's been going on with coal inventories, for example, there was a lot of talk of there being extra capacity out of Inner Mongolia, but actually coal prices hit new highs in China recently, in sync with the rest of the world's coal prices. And then you look at certain other commodities as well. Oil is probably not in the top 3 commodities getting policymakers' attention in China right now. But my underlying message is numbers are going up. Now, the second demand is going up. The second thing is that there were some new quotas released early last week, whereby it is permitted for Shenghong, one of the new large independent refineries, and also Rongsheng to import a little more crude for the balance of this year. And the former is of relevance because they are saying they're ready to start in November, and they were given a quota to import crude, to actually have crude ahead of their startup. So that signals that private enterprise is being given support to run its refineries, and that there's going to be a lot more crude oil demand from China than people had factored in with the previous set of quotas.
And
I disagree.
Christof, just follow up, please. Go ahead.
Yeah, I have a very different view on that. This is not a sign of strength or of strong economic growth, just the opposite. What we have seen in China is a number of political campaigns now against, the high-tech industries, the education sector, against kids, sitting and playing video games all the time, against the celebrity culture, all designed to reestablish the political leadership, sort of hold on the reins. Every time we see something like this historically, it either coincided or it led to a slowdown in economic growth. And that's exactly the situation we have again. Of course, China is growing still, but it is no longer growing at 8 or 8.5%. The question is it growing above or below 6%? And with that lower economic growth comes lower demand for oil products. Now, what has also happened over the last years is that we have seen a relentless increase in Chinese strategic reserves and commercial reserves. They're actually the same. And nobody in the world can tell you exactly what the capacity is. So people are trying to guess with satellites. And so we don't have firm inventory data for much of the world, of the non-OECD world, and certainly not for China. So capacity must be, however large it was built up, must be pretty full. What we also have seen is that, especially in 2020, China made use of the the situation and the very cheap prices and stocked it up some more and bought even some more oil. So there will be an incentive to get rid of some of that oil. There's now a good time to get rid of that oil and indeed support domestic refiners and thereby Chinese industry, because slow growth is slowing down. So this is not, some red hot economy firing in all cylinders, using more oil than they can buy from Saudi Arabia. This is again a sea of oil, too much oil, a slowing economy, and then adjustment of these commercial inventories and stocks. The high coal prices hit record levels is true, but that's because of a shortage of supply, because there was a big hiccup with Australia and no coal deliveries from Australia. The thing we need to talk about is not only affecting China, but increasingly also Europe, is the very high gas prices, which came about as a result of supply constrictions, especially in the US, and of very, very strong Chinese demand as they try to go away from coal a little bit and clean up their environment. That is a concern, which is also not positive for the Chinese economy. But overall, we've mentioned this now on several occasions. I think China is still a bit of an enigma here, how bad the situation actually is. But sign after sign after sign which comes out doesn't point in a very positive direction.
Mike, your thoughts to come back on that, just to note, in general, we've seen revisions downward in GDP outlook. Goldman Sachs last week did it on America, that the outlook for China does, the consequence of this government policy, social policy, does indicate potentially slower growth. Your thoughts?
Yes, and in addition to that, a lot of people are pointing at China trying to accelerate the decarbonization and introducing measures to promote less intense use of fossil fuels also. But I always like these discussions because Christof comes at it from the geopolitical and the macroeconomic side, and I come at it from what I see on the ground in terms of supply demand. And I can report that China is buying more oil than it was when I was last on this program. And there are more tenders, there's more activity among depots.
Of course, the demand increases. It just increases at a slower rate.
Yeah.
Yep.
And it's always difficult to compare the here and the now, because we are now trading November crude. And for November, people have a very, very different view on where we're going to be, purely based on vaccination progress. Now, China's already there very much, as are places like Singapore, but economies that kind of matter because they're quite noisy in the media, like Australia, you have to recognize that by November, if they carry on with the current vaccination rate, they'll be 70-75% vaccinated, and they'll be able to start considering ways of having a mix of vaccination passes and possibly opening up the economies again. And of course, much more relevant where the Asian tiger economies are going to go with all this as well, because the vaccination rate is on that steep part of the incline curve in many of these places. So there is some hope that there will be greater demand stemming from all that, and that's the horizon which we're trading. November crude equals processing in late November equals, or even processing in December, which means demand at the very end of the year. Very, very different place on the vaccination curve, and possible shift from suppression policies to opening up and living with the virus than we have today in September.
Just on that point, Mike, I mean, that curve of time, we've had some very strong statements out of the US last week, and we've kind of had this over the last year or more. China's been the strength pillar of the market, then America's been the strength pillar of the market. I'm just wondering, from your view, are we witnessing America sort of losing that posture of being the ultimate pillar for the market? COVID is massively resurgent there. We've got the Biden mandates on mask wearing and so forth. Your thoughts about where the US outlook is on demand side?
Yes, I heard him on the radio and he sounded quite stroppy. We're paying for your vaccines, take them. Yeah. No, there's no question. If you look at the fundamentals at this time of year, it is Asia that will be responsible for most of the incremental oil demand over the next 3 months of trading. No question about it. So yes,
that's been for the last 10 years.
And Christof, on that point, with these sort of downward revisions of GDP outlook, goes the talk of tapering and monetary policy easing gets wiped off the table. So ultimately, it could be positive for markets because it keeps the accommodative policies in place for much longer than we had maybe thought a few weeks ago. What are your thoughts on that?
Could be. I mean, remember the euro crisis after 2012. And basically for years, I think for 2 years or so, every time bad economic news came out, it was good news for the market. It turned into a running joke because you needed high unemployment numbers for the Fed to continue tapering at that time. Not to continue quantitative easing at that time. And that was perceived as positive by the market, who then bounced. And it could be that we go there again, but I don't think so, because the situation now is a more dangerous one. So you can look at it from two sides, from the market point of view, as Marx says, and from the macroeconomic point. From the macroeconomic point of view, we have the three big blocks, the European Union, the US, and China, in sort of this long-term race on who's growing the fastest, who's becoming the biggest economy. We clearly see Europe falling behind. We're not so clearly seeing China advancing. China is first in the sense that they first conquered the consequences of COVID. But the growth slowdown there, again, by all indications, has been quite strong. And the US, the jury's out to me. So strong, the rebound was very strong. Is it a flash in the pan or not? That will now depend on how they deal with the half of their population which refuses to vaccinate. It's actually a very simple situation. The rest of the world increasingly comes to the conclusion the UK has already drawn, that we have a population, if it's vaccinated, we are fine, we can drop the lockdown measures. If they're not vaccinated, they suffer the consequences. That you can do if 10, 20, maybe 30% of your people are not vaccinated. You can't do that if it's half and half, because it will bring down the health system. That's the situation the US is in. So Biden either needs to persuade his guys to take the shots, or he needs to cope with a slowing economy. That's their problem. So they're more likely to come in between. From the market's point of view, this is not exactly the scenario where you hope for sort of bad news a little bit because some low wage receivers are unemployed and then stock markets can continue to rise. It's a more fundamental problem, because if really lockdowns would come again in the US, or if somewhere in Asia suddenly a new variant would come out, markets would get genuinely scared and would also come down despite the continuation of tapering. And so I think also on the other side, what you see now is a much closer cooperation. The ECB last week came out and by all intents and purposes announced they would slow down asset purchases. The Fed is still on record by saying by the end of the year they will do the same. So they try to coordinate that and try to slow down the injection of money in the economy while holding off on the interest rate adjustment, which is the really sort of the stronger tool, the hammer. So they do the nail polish a little bit adjustments, but on the big monetary policy toolbox, the interest rates increases are being postponed in both camps at the same time.
Mike, your thoughts on that from the market point of view? If this accommodative policy does last longer, and it clearly is lasting longer, I mean, at least the talking, as they say, if it lasts longer, do you think some ramifications might be for oil markets?
Let me look at it from the Asian perspective again. I mean, in recent weeks, Asia has had a lot of reassurance from things, horror scenarios, if you like, on demand not coming true. China did have a couple of flare-ups of virus, and they pretty much contained them. There were 2 days last week when there were no cases, at least officially reported, and then sometimes they play a catch-up. There were 6 cases in Fujian and 1 in the Shanghai area. One or both of them apparently Singaporeans who had traveled there. I think the market had been pricing a lot of China risk into that. That was the one thing that oil markets were worried about, is that China has another virus problem to contain. And the way they go about it, as we know, is to involve mass testing and shut down entire neighborhoods or entire cities to quickly nip it in the bud. And I mean, if you look at what's going on here in Singapore, it's quite interesting. We're at the highest level of cases now for 2 consecutive days than we've had since 2020, since the very darkest days of 2020, when we had issues in the dormitories of workers. And yet Singapore is 81.5% vaccinated, and pitching out at the sort of level where you can't really vaccinate children under 12 because there's no policy to do so yet. So for all intents and purposes, Singapore is vaccinated, and yet the government is still choosing to play it really cautiously. So that mindset has been baked into a lot of economies: Thailand, Vietnam, Philippines. I mean, a lot of these places are still seeing very, very cautious approach towards buying. And because of this lag I highlighted earlier between the trading horizon, which is November, and where we're at here in September, there is a risk that people will underestimate this. And we saw this in India. India was a great test case for this, which, largely self-vaccinated by, having dreadful statistics on casualties, of course. But India is now, in many parts, I'm told by colleagues who are there, maskless, and life is back to normal again. And there were periods in the resumption of demand when India had under-budgeted and didn't have enough supply, and had some rather prompt tenders to rectify that. And indeed some SPR releases, which we're seeing again now for other reasons. So I think there is a chance and an expectation in the markets that Asia is going to come roaring back. And yes, Christof, of course it does. Every Q4, Asia is responsible for global oil demand growth. That's just the seasonality of things. But there's an expectation in the market, I think, that Asia could rip.
On one level, they may stop buying gas and might be buying more high sulfur fuel oil.
I'm glad you came back to that, because the utility sector has been very pronounced. For us to have $20 per MMBTU gas price or $19 TTF in September is a seasonal record. This is not the time of year when gas prices normally go to those levels. And Christof, a lot of it's emanating from demand outages, but also all this concern about, and I think you highlighted in your story that you sent to us, Sean, Amos Hochstein was commenting to the Europeans he was visiting that, let me just paraphrase, Russia might use gas as a supply tool, as a political weapon. So sitting in Germany there, Christof.
Certainly a powerful card right now. I say it's certainly a powerful card right now. That going into the winter on the gas pipeline. Let's just get the survey question from the group and give everybody a chance to comment on this particular point. Just picking up on Joe Biden's the Thursday comments that Mike referenced earlier, new vaccine mandates from his control, if you like, he can mandate across the federal government employees, and highlighting that there's a tough stretch ahead. Worth noting that there's close to 200,000 daily infections in the US, 1,500 people dying a day still from COVID in the US.
Sean, good or bad for which markets? For energy markets or for financial markets?
I would be, on the good point, thank you. I was going to say wider financial markets, including energy. Yeah, wider financial markets, including energy, because ultimately, as the point made with Christof earlier, it keeps the taps, the monetary policy taps open, and consequently, that has been good for markets. So in that sense, is it still good for markets? And oil in that basket. So that's my question to everybody. It seems like it should be negative for GDP, but maybe positive for markets. In essence, the idea that if you keep the monetary policy taps pumping, even during difficult economic times, they have so far delivered a serious upswing for the markets. Will that continue? Christof, your thoughts, and we're looking into next week now at what will come ahead to keep this market moving upward.
I mean, to your question, I think this is very straightforward. What we know is that vaccinated people may get COVID, but they rarely end up in hospital and they rarely die. And so the more people you are vaccinated, the lower the economic cost of COVID and the less need for any kind of lockdown. And this is the US problem, because half of them are some crazy Trumpists who said we don't want to be vaccinated, and they block hospitals and they die and they weaken the economy. So that's why he is trying to look at the mandatory measures, which must be very unpopular in a country like the US. Much of Europe is ahead of that because vaccination rates are higher. Asia is ahead of that usually, but some poorer countries don't have the vaccination, and the Chinese vaccination is not as effective, so the infection rates are higher. I think that fundamental impact trumps the short-term monetary policy impact. And I think that both the Fed and the ECB realize that they cannot keep on these asset purchasing programs forever because the inflationary pressures are getting too big. So they don't want to raise interest rates because that would have really been a hit to the economy. They have to stop pumping money into the economy at the same time because inflation rates are getting to quite record levels in Europe and in the developing emerging markets and in the US. We're everywhere about 3%, many places about 5%, many emerging markets even higher. And that spells trouble because then the exchange rates go, then the debt crises may emerge, and nobody wants that in the current situation. And therefore, I would on that question, go with the fundamental level of a positive impact of high vaccination rates and vice versa.
Mike, with this week coming tomorrow, we have the OPEC release of its monthly oil market report. Reuters surveys indicating they expect a revision down for global oil demand in 2022. Your thoughts on the outlook for that report and any other events in the coming week?
I've had the pleasure of engaging with a bunch of consultants and advisors and experts on oil demand outlook because it is very important to us. And what really flabbergasts me is the range of expectations, how wide it is right now, and also how the baselines still diverge. In other words, people still don't have a common set of numbers for Q2 and Q1 of this year, which is absolutely amazing. But yes, I mean, the fundamental fact is the world is drawing oil faster than the 400-day that OPEC is putting back in. Christof mentioned earlier Guyana, Brazil, the Johan Sverdrup field in Norway, coming on, adding some non-OPEC supply to the mix. But the biggest issue really is how does demand juxtapose against supply? The OPEC policy of putting 400-day in the market is commonly believed to be not enough to satisfy demand growth at this time of year, and therefore it is going to allow a continued drawing of inventories. And the rate of those inventory draws is awfully hard to track, because it's not just publicly disclosable stocks in places like the DOE stats in North America, European stocks, Singapore stocks. Those are easy to see, but it's also oil and water, and it's inventories in countries that don't have transparent or publicly available data. But the range of expectations there is wild. But I think the consensus level is that August would have seen us draw by around 2 million barrels per day. And that's, of course, 5 times more than OPEC have been putting into the market incrementally. And then I think Christof mentioned earlier that certain countries in OPEC Plus have actually struggled to keep pace with it. So they've not even been producing at their headline level. One of your 10 articles you put up here, I think today or yesterday, indicated that even Russia was behind its numbers. And the same, of course, goes for African OPEC nations who've had production problems, such as Nigeria and Angola. So all in all, the demand is outstripping supply and inventories are going down. And this will manifest itself at some point in the visible data in the consuming centers. And that should justify a backwardation in the markets, which we're seeing. And it's rather interesting to see that now that we have a tighter supply-demand picture than we had before, the backwardation in the oil markets, in the crude markets, at roughly 60 cents a barrel a month is nothing like the backwardation which peaked when we had the last price, let's call it excursion into the very high 70s towards $80 a barrel, when we hit 90-something, even close to $1 a barrel a month backwardation. So that relativity has gone from being too much backwardation given inventories to arguably, in historical terms, too little backwardation considering inventories now. So it's an interesting one, especially if you consider the inventories aren't the whole story, because demand's coming back, and therefore you should really look at it in terms of days cover.
Christof, your thoughts for the coming week, and welcome your views on that dichotomy. The world economies could be softening in terms of not growing as bionic as was previously forecast, but nonetheless significant enough to keep that imbalance in place, as Mike just pointed out.
I mean, this is a situation where oil markets are at the receiving end. It's driven by the economy, by economic recovery, and by demand. First point. And that doesn't look too stellar. And the big question here is, everybody knows you pump money, you swamp the economy with money, you get a quarter or two of high growth. But the big question is this a flash in the pan and will then usher in inflation and no real economic growth above trend? Or is that something which helps us to go back to the trend lines which we had before 2019? And that one, the jury's out, but it looks sort of 60-40 that it's lower trend growth. And not higher one, that it is a flash in the pan to some extent. Secondly, every 4 weeks, Jorge comes and says oil prices will go to 80, and Mike says China will bail out the world. It just hasn't happened for many, many months now. And the reason is so obvious, that there is too much oil, there's spare capacity within OPEC. Okay, they may have 1 month, where demand exceeds supply, but everybody in the market is no fool. They're good at anticipating things, knows that this could be corrected by producing a lot of more oil easily. We know that even the cautious restructuring of shale, what comes back on there is probably more stable than what has left the market 1-2 years ago. So there is no shortage of oil, and therefore we don't see the price spikes despite all these adversities which have happened. And therefore I think OPEC will continue to sort of be on the tight side, not only also because they can't deliver much more production, but also because they don't want to see prices go to 50 or 40. So I would, looking out, I would again try to point out some other things which will be important in the medium term. One is the high gas prices, what that will do to oil substitution, to fuel oil demand globally, also to these targets for in the Glasgow meeting, the COP climate change meeting, as you see everywhere, coal being sort of used and gas being phased out in countries. The other one is things like we have elections in Germany. You always ask Carol about this.
Yes, I know. I know Germany and Canada.
This is also probably something which is going in a direction which is not necessarily stellar for growth in the European Union, but more high tax size. Third one is we see now the costs creeping up. Look what happened in the UK. I mean, somebody like Boris Johnson announcing a tax increase package as he did last week. So that's a serious warning sign for that the cost, the bill is coming due, and that again goes in ways on economic growth and therefore oil demand. So these are the little bits and pieces. I think it's a bit painstaking and a bit boring, but one has to keep track of to really sort of sort the first big question, which is demand. And demand is at the moment dependent on the economy. Supply, we have enough.
the survey response, and give Mike the last word. So bullish, more money printing, more bullish markets. Mike, your thoughts as we have you this early September or mid-September now, actually 9/11 yesterday, we're remembering and acknowledging, but outlook for the wider cycle of time in the coming weeks.
Yes, if I can just quickly point out an election item that caught my attention, the Norwegian election, where the mandate is likely to swing away from the centre-right to the left government, which may not be able to govern without going into coalition with the Greens or the further left-wing communists, both of whom have demanded an end to exploration in Norwegian waters. I mean, should they need to do so, it's marginal. They'll probably have a mandate, but if they don't, that would be incredibly interesting news also. In terms of outlook, I think we haven't really talked about Iran yet, and it's quite topical that we have the IAEA envoy on his way to Tehran today for a quick visit, and the scope of the visit, which is very short notice, is possibly out there being misinterpreted and downplayed. I think it's fair to say that all expert observers put back in their thinking the point in time at which they expect Iranian crude to come back. It's very important for balances because many people were seeing it later this year, early next year, and I think the consensus has now swung to middle of next year in most people's supply-demand balances. And if you add to that the fact that China is taking a lot less oil that came from other sanctioned sources, sometimes under exemptions, of course, such as the Iranian, which traditionally goes into China at a rate, but also Venezuelan, those flows are way, way down. And it will be very interesting going forward to see whether Biden seeks to somehow make amends for being criticized for being weak on Middle Eastern foreign policy. There was an interesting story about removing Patriot missiles from Saudi, claiming that the Saudis can now defend themselves, for example, just on the very day when another Houthi missile made it to a Saudi airport and did damage. So it'll be very interesting to see whether on the foreign policy side, there's a slightly more strong enforcement mindset on the part of the Americans by exerting pressure on the banking system, the shipping system, the insurance system, to prevent sanctioned barrels from flowing into the market again, because they've ebbed and flowed. They're currently at an all-time low. Venezuelan, of course, is hardly flowing at all. And Iranian volumes, both crude officially sanctioned to China and less officially or not sanctioned product flows, have been down at all-time lows. So if they were to swing back, that would be quite important. And it would be very interesting and also a great foreign policy opportunity, in my opinion, for the Biden administration to show some teeth there, because that's something they haven't yet done.
Okay, well, let's wrap it up there. Joe Biden and teeth. It seems to be, unfortunately, lacking some, or at least being criticized for doing so. And the politics of America, I think, start to be, as Christof mentioned, Germany. The nastiness in American politics is starting to creep in a year out from the midterm elections, and that will also have its ramifications. Just posting as a closure, the sad news, obviously, that we had to postpone our forum in Fujairah for 6 months due to their ongoing challenge with COVID, and they have taken that decision to let's pause and do it in March. So we will. So that's a wrap. Thank you, Mike, as always, from Singapore. Thank you, Christof, from Germany. And enjoy the last few days of the election there. It looks like it will be an interesting result. A new beginning, regardless, was the end of the Merkel era. And for all Europeans, that's a big, big move. Thank you, everybody. We'll catch you during the week every morning, 10:30 UAE time. All the best and have a great day.
Thank you.